Crisis creates fear. But for emerging markets, it also creates opportunity. How are emerging markets leveraging geopolitical tensions for economic growth? As major powers clash, supply chains break, alliances shift, and emerging economies position themselves to attract investment, manufacturing, and strategic relevance. 10 ways emerging markets turn tensions into growth. 1. Supply chain diversion. Companies move production away from rival powers. Emerging markets absorb factories. Jobs increase. Exports grow. 2. Strategic neutrality. By staying non-aligned, countries trade with multiple blocs, maximizing excess, minimizing risk. 3. Manufacturing relocation. Rising costs and sanctions push firms outward. Emerging markets offer cheaper labor and regulatory flexibility. 4. Energy and resource deals. Geopolitical disruptions raise demand for alternatives. Emerging markets supply oil, gas, minerals, and food. 5. Defense and security demand. Regional tensions increase military spending. Local defense industries expand. Technology transfer accelerates. 6. Trade route importance. New corridors gain value. Ports, railways, and logistics hubs become strategic assets. 7. Currency and payment experiments. Sanctions pressure pushes alternatives. Local currencies gain use. Dollar dependence slowly weakens. 8. Foreign investment competition. Major powers compete for influence. Emerging markets negotiate better terms. Financing improves. Technology flows in. 9. Diplomatic leverage. Votes matter more during global rivalry. Emerging states trade diplomatic support, freed, access, and concessions. 10. Long-term repositioning. Tensions are temporary. Capacity is permanent. Countries that adapt early lock in growth for decades. Subscribe and stay updated.